This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. This is the Definitely Uncertain podcast, and my name is Darren Rockman, and I'm a partner at Goldrock, the 25-year-old multifamily office servicing high net worth families in Israel and around the world. And I am very pleased to welcome back to the podcast one of our favorite macro and favorite guests in general, Daniel Krausz. Hi, Daniel.
Hey, Darren. Thanks so much for having me back.
Hey, it's great. Thank you very much for joining us. Daniel is the founding partner and macro portfolio manager at Blue Door Asset Management, which is an equity hedge fund based in Stamford, Connecticut, and Sixth Capital Macro Consulting. And before Blue Door, Daniel was portfolio manager at Amiga Advisors, which is a $10 billion New York City hedge fund. Daniel comes from New York. He's a Shiva University graduate, and he also has an MBA from the Wharton School. So Daniel, we want to talk a little today about macro in general, and specifically about government debt. But before we jump into that, just tell us a little bit about what you do at Blue Door.
Sure. So Blue Door is a concentrated equity fund. We have both long, short, and long-only strategy. We tend to invest in very non-index-like companies, so a different profile than what you get in S&P 500. In addition, what we do that's different is that my partner, Mike, focuses on bottom-up, and I focus top-down. So we're taking approaches from two different perspectives to identify the best long-term risk-reward opportunities. And so we vet every company we own, both bottom-up and top-down. We also use the macro side to help with the risk management to make sure that we're appropriately hedged when we view it necessary, and to make sure our portfolio doesn't get overly levered to one factor or theme.
Got it. Okay, great. So you're a macro analyst, and one of the things that you've been looking at for many years, and I've been looking at for many, many years, perhaps because I'm a little older than you, is the issue of rising government debt. And that is true across Western markets, the UK, the Eurozone, and of course the United States as well. So let's ask a sort of general question. How worried should investors be about the fact that the government is so indebted? And what is the extent of the problem?
So we should be worried. Definitely, we should be worried. But first, I think we have to really take it down to kind of first principles, right? And so we hear a lot about rising government debt across Western markets. It's something that everyone's talking about, and I'm really no different. Over the long term, the debt we have will continue to build is definitely a problem. The fact that everyone knows this, though, in the short term makes it a little less interesting, right? And so what we really have to understand is why is it such a problem? And then we have to understand how can we identify when it will be a problem and what the word problem here really means.
Okay.
And so first, we have to understand what got us here. So government debt has been building for quite some time. About 13 years ago, we had a near systemic issue in Europe with government debt over there. But in the US, we really haven't had any real issues. People have been concerned about rising debt for decades here. But if anything, rates have actually stayed quite low. And so what happened during COVID and subsequent years is that we had a large amount of social benefit spending, in fact, the largest that we've ever seen. And then we followed that by one of the largest amounts of government investment spending that we've ever seen.
Right.
And so now, in addition to much of the spending, is now become mandatory spending. And so the ease
which is Social Security.
Social Security, just all forms, different social benefit spending that's mandatory, like, added jobless claims, jobless insurance benefits, and things like that. And so the fact that so much of it is now mandatory spending, the ease that we can recalibrate is really, really difficult. And so now we have to see.
Because we're talking about retirees, we're talking about people with health issues, talking about people without a job. Those are people for who are effectively living off these transfer payments, and to pull that away from them would be very, very disturbing to the economy, and also would be politically unpalatable.
I think it would be nearly politically impossible. Yeah.
I was just being kind.
Yeah, exactly. In addition to that, interest rates went up. And so the interest on the debt is also rising dramatically to the highest levels as a percent of GDP that it's been in decades. So just to put that in perspective for a second, so the current 10-year, using the current 10-year, the implied interest expense as a percent of GDP is higher than it's been at any time back to 1963.
Right.
So with rates sub 4%, we have the same interest expense as a percent of GDP as we did when rates were in the teens. That leaves us very little room for rates to move up without
Okay.
going.
So to break it all apart, you can't really bring down spending, right? Because so much of it is going effectively to the poor and low middle class voters. And your interest rate is, at reasonable rates, is starting to choke off your ability to do other things because it's taking a larger and larger part of the
Mhm.
government's spending.
That's exactly right. And then when we go further, right, we have the demographic problem, which you were mentioning. So we're on a path to where 20% of the population will be receiving Social Security benefits, right? So entitlement requirements will be rising substantially every year. So that's where we are and how we got there. Now for the other side of the story. So how much debt is too much debt, and when does it become a problem? So I have a very not fulfilling answer for you on that. And that's there's no way to pinpoint that before the
Right.
fact,
It
right?
depends. It's
Yeah,
is it
exactly.
hold on a second, Daniel, you saying it's context dependent because you're not allowed to say that anymore.
Yeah, no, I would never say such a thing.
Right.
But the truth is, right, every country, every company, every household has different debt capacity limits. And we've seen that over and over again. And so you can't just generalize this is where debt becomes a problem. The good thing is, though, we do have signposts that we can watch. And so we watch at Blue Door, we watch a few different things to identify when it could become a problem. So first, you want to look at the level of debt relative to the level of money supply. So debt becomes a problem if there's simply not enough money to service all that debt.
Right.
Currently, that's not indicating a problem. Now, of course, that can change, and there it's not the only factor, but that's one important factor to watch. Second, when debt's a problem, we'll see less capital flows from outside the US into the US, right? People will stop wanting to finance our debt. Right now, capital flows into the US have been some of the strongest we've ever seen. So that doesn't signify a short-term problem. Third, and this is a little bit wonky, but you see term premium in bonds rise. And what that really means is that the level of interest rates relative to the level of growth starts to rise. And that signifies that the markets are saying we need a premium. The US government needs to pay a premium for us to hold their debt. You don't see that right now. And fourth, you look at what inflation expectations are doing. If debt is becoming a problem, and therefore you now have the government having to print money essentially to deal with that debt, you should see inflation expectations rising. Right now, inflation expectations are actually quite tame. If you look at the break-even inflation, which is how the market prices the expectations for
Mhm.
inflation, they're about the levels that they averaged in 2018,
Okay.
right? So
So what you're describing is we have a fundamental problem. But when you look at the short term or the current indicators,
mhm.
those indicators are not telling us that the problem is affecting markets, affecting the ability of the American government to finance that debt in the foreseeable or the near to medium term future. That's what
Yeah,
those indicators are telling you. I
that is
want
what I'm saying. So, yeah, sorry.
go ahead, go ahead.
No, I just say that I think put really simply, the long-term signals here are flashing red, but the short-term ones aren't at this point. And the
Okay,
reason that's important is because the long-term ones have been flashing red for a while. And so
okay.
it's important to identify when do you start getting nervous, and that's why we have those signposts.
Okay, kicking the can down the road, investors are not immediately worried. Is that because America looks the best of a bad bunch?
So there's definitely an element of that. We we look the best of a bad bunch, but I think that importantly, we have real innovation here. We have real return on capital here. So like let's look at Europe. They have a debt problem also. There's also no innovation happening there, right? They have a demographic problem there, much worse than we have. And so why finance that? Why send my capital flows to an area where there's less innovation, less return on capital, and worse demographics?
Okay,
And so yes, from a government perspective, kind of the cleanest dirty shirt in the laundry, as people like to say.
right.
Um, But from a big picture perspective, there's still real innovation happening, which is at the end of the day what creates value.
Because that generates productivity. But
Exactly.
I want to ask a sort of broader question. One of the things that certain commentators tend to focus in on is this being unsustainable. Ultimately, this poses some type of systemic risk. That is, yes, America may be, as you say, the cleaner shirt in the dirty laundry, but at some point in time, the market might recognize that the laundry's all dirty and therefore we have a real problem. Can you see that actually happening? That it becomes less of a relative gain and more an absolute reduction in confidence across the system?
So yeah, so this is where you kind of the rubber hits the road, right? This is where government debt becomes a question of markets, which is really what we care about at the end of the day,
Yeah,
right? And so before we can attack that, we have to understand what is the market concerned about, okay? And so the big picture question is debt inflationary or deflationary, right? And that's actually a much less simple question than it may appear, because the lesson of 2008 to 2020 was that debt is deflationary, right? We couldn't get inflation to save our lives during that time.
right.
And we had a lot of deflationary concerns throughout the world because of high debt. The lesson of the last 4 years seems to be that debt is inflationary. So which one is right? And I think that to come up with the answer to that, you need to distinguish based on who the indebted party is and how the debt is serviced. So let's take a step back. When the private sector is over indebted, the way you service the debt is that you divert cash flows away from profits and investment and towards debt service. So this is deflationary because it saps demand from the system.
Okay, so somebody's got a mortgage on their house. Rates go up. They have to. Well, they've taken more debt. Now they just have less money to spend on other things, and that's true of
Exactly.
corporations. It's true across the economy.
Right. And
Individuals.
it's also important to realize that when does debt become a real problem in the private sector? Usually after one of two things or both happen, which is some kind of demand binge, which has brought a lot of demand forward. And
Right.
now I'm left with less forward demand, but also more debt. And so I'm diverting more cash flows away, or some kind of huge capacity build, which is also deflationary.
Right.
Right. And so that's what the private sector looks like when it's over indebted. And that's what you saw from '08 to 2020, an over indebted private sector delevering.
Right.
That's deflationary.
Right.
When the government is over
What
indebted,
what's also known as a balance sheet recession.
exactly. Yeah. So when the government is over indebted, they can actually choose if it's inflationary or deflationary. Because what they could do is they could tax or they can go with austerity and severely cut back spending. So what that is that's akin to the private sector debt repayment, where you're diverting cash flows from other projects towards debt service. That's deflationary. That's a problem. If that starts to happen, the market's concern that you're describing will be one of deflation. And so that will create asset prices lower. That will hurt the economy as a whole. The other hand, the government can choose to make it inflationary. They can choose to continue to spend and just print the money or create regulations to create more buying of bonds and make sure there's still demand for their debt out there, right? So that's inflationary. In that case, markets will get more concerned about more inflation, and therefore I'm not getting compensated for my risk from your bonds. And you'll see the market say, we're not buying your bonds anymore. So those are two very different risks. That's really important to understand that the difference between a private sector balance sheet issue and a public sector one is that the public sector gets to choose which problem it prefers.
Okay. And that ultimately becomes also a question of politics, right? And
Correct.
if we
Yes.
look at both political parties at the moment, neither of them seem to be inclined towards either significantly increasing tax, although perhaps one would argue that the Democrats are slightly more interested in that. And definitely neither of them are proposing any form of cutbacks in government spending or austerity or anything meaningful in that sense.
Yeah. So the history of this problem is such that usually it's one of two outcomes. Either policymakers choose to inflate away the debt, and so they print more, they create regulations to make sure people are still buying the debt. They create yield curve control so that rates can't go up, beyond a certain amount, which you saw post World War II, right, leading into the Fed Treasury report of 1952. Um, and that's inflationary typically, but also good for asset prices typically.
And that's really what we saw 2000 through to 2003.
Yeah. Yeah, no, I think that's right. The that's choice one. Choice two ends up kind of in the same spot typically, but goes through some pain first, which is the other choice that you see historically is no, we're going to cut back. And then the economy suffers and asset prices suffer, and then a new administration comes in and says, no, no, we can't have this.
Right.
Right. So in both scenarios, you typically end up in the same place. Not always, of course, but typically the path to get there can be quite different, though. And
Right.
that's why these signposts are so important
Right.
to navigate.
But printing money, generating inflation, that also works because it will depress a currency and make an economy more competitive because there's just more dollars in circulation. So, the relative value of the dollar against other currencies would go down. And tell me if that's right. And if it is right, then how does that work when all the other major economies have exactly the same problem? At least most of them do.
So what you're describing is a trade issue, right? That when your currency gets weaker, as Japan kind of has seen, they've had a boom in their exports, in part because of the weaker yen.
Yeah.
That's a trade competitiveness issue. What we're discussing has more to do with a kind of soundness of the currency
Hmm.
and willingness to finance the debt as opposed to trade competitiveness.
Right.
And so what the government would be saying is we prefer a weaker currency to not having the ability to finance our debt.
Okay. And
Those are two different things.
right.
Yeah.
Okay. And if we reflect on the experience from 2000 through to 2003, 4, where there was a huge injection of dollars into the system by the Fed. At the same time, a lot of spending by fiscal spending by the government. That then triggered a meaningful inflationary concern. Inflation getting up to sort of peaking around 8-9%, and then sort of coming down from there. Um, can governments do this in a controlled fashion, or can the Fed do this in a controlled fashion? Or do we risk going back to the concerns we were all sort of really worried about 24 months ago?
So yes and no, right? It's a matter of time frame.
Right.
There's a lot of scenarios here. The truth is what the government gets to choose is it deflationary or inflationary approach? How much does not really end up being the choice of the government. So for instance, there's a Goldilocks scenario. They choose to continue to spend. The Fed accommodates it. And so policy is easy, money is flowing. And by the way, AI creates this big productivity boom. In that case, your inflation will be higher than the counterfactual if it was just AI without that. But it's not necessarily problematic because you have this big productivity boom from
Right.
AI.
This is sort of akin to what happened in the US post World War II.
So Percival Roller 2 is a little bit different in that there's similarities, but it's a little bit different in that you had a full industrial rebuild.
Yeah.
You could get like shadows of that. It's not totally crazy, but it's a little bit different in the sense that you do have this AI potential, which would help a lot. That was kind of the 50s where inflation started to come down, not quite the 40s.
Yeah.
But um, but at the same time, you have the demographic issue here, which is quite different.
Yeah.
And so that is kind of a little bit of an unstoppable train.
Yeah. Absent significant immigration, which again,
Right.
starts to run into
Correct.
politics. Okay. So that's been a fascinating analysis, and one that you don't really hear in, certainly not in the mainstream press, and even in most analysts don't look at it that way. So let's take that into sort of practical terms. What are the paths for investors, given what you were talking about? And let's divide it into two parts: short term, long term.
Yeah. So in the short term, I think it's watching those signposts. In
Yeah.
the short term, liquidity is still strong. Growth is okay. We'll see where it ends up in 2025. Obviously, things can change. But when you have strong liquidity and okay growth, you'll have ups and downs, but it's not something where you're problematically concerned.
Okay.
If you're thinking about tail risks from government debt, you're really thinking about the dollar and bonds. And the truth is that I think what's most important for investors to understand is that when people talk about the debt, they're often talking about these doomsday scenarios. And a debt problem can just as easily result in an equity boom because of how much money gets printed
Right.
as it can result in an equity breakdown. And that's why diversifying across these asset classes and understanding what it is that you're hedging, right? So, for instance, if we take that kind of by asset class,
Mm-hmm.
right? And so, the way I like to think about a portfolio as a whole and diversification is what is the bet that I'm making in an asset class? Okay. And so when it comes to bonds, you're betting in favor of productivity and against outlandish fiscal and monetary policy, right?
Right.
That has been a great bet for 50 years, right? For all of the concerns over that time of too much fiscal and too much monetary, the truth is it was pretty contained. Um, and productivity was positive. And so bonds did quite well. When you're betting on commodities, you're betting against productivity, right? Almost by definition, the more productivity you get, the more output per unit of input. If I'm getting more commodities per unit of capital, then
Yeah,
that's
sure.
positive productivity, and that actually depresses commodity prices. So you're betting against productivity when it comes to commodities, and you're betting in favor of outlandish fiscal and monetary policy. Okay. With equities, you're betting in favor of productivity and in favor of even just supportive monetary and fiscal policy. And then let's go to a fourth one, which is real estate. And the way I think about real estate is it's interest rate levered equity bets at the end of the day. And so productivity is good for it. So is favorable monetary policy, but you have to remember that much of your returns come from leverage.
Right.
And so that's an important aspect as well.
Okay. So if let's take there were two sort of paths that you sketched out for us. One is tax slash austerity, and the other one is printing money. Um, so if you assume that the more likely is printing money in order to deal with this debt problem, that would
Mhm.
seem to indicate a better bet for equities, uh, not as good a bet for commodities, and not really interesting in terms of bonds.
Okay, so let's think about this a little bit differently. So equities are the core value creator in the economy, right? They innovate. Commodities don't innovate. Commodity and oil is oil is oil,
Yeah.
right? Oil is going to be used for something else. It's because a company comes and innovates,
Hmm.
right? And so that's the core value creator in the economy. And so equities are a core allocation as a result, except for when you think that productivity is going to get hurt or the amount of capital available to finance equity is going to hurt,
Right.
right? So that should be how we think about it on a core basis. And so if they're going to print a lot of money and there's still going to be capital available, if that's the scenario we're choosing, then equities should be continue to be your core. Now
Hmm.
let's think about the hedges, right? The extremes. So in that case, commodities are actually the better hedge than bonds. Okay. Because if you do get continued fiscal spending, more and more of it, and continued monetary liquidity, then commodities become your tail risk,
Right.
where inflation becomes so problematic that now something has to happen.
Right.
And so around your core, whereas it was a 60-40 portfolio previously, right? Bonds were the core because productivity and outlandish fiscal government was not an issue.
Hmm.
Now you actually have to split that hedge. And so in the scenario that you're describing, the money printing scenario, commodities become part of your portfolio as a hedge.
Hmm.
And then within bonds, you want to stay shorter duration because the truth is, if you look back at the 70s, which I do not think we're in a 70s type of scenario, just to be clear, but if we take that type of scenario, short-term bonds actually did quite well because you're
Right.
constantly reinvesting at a higher rate. And so in that scenario, that's how I would think about it, where commodities are actually your hedge
Yeah.
within still that core allocation.
Mhm. Interesting. Okay. I just want to touch on a couple of other things
Mhm.
that are going on. The first is geopolitical risks. So, let's break this down into two parts. There are two major wars that markets are looking at. One is obviously in the Ukraine. The other one is here in the Middle East. How should we think about investments in light of those? And secondly, what does that mean for the future in terms of the growing trend of the world to break into two blocks, one around the Western democracies and the other one around China, Russia, and Iran?
Yeah. So you can get into a lot of trouble trying to attach geopolitical to tensions to markets. And so again, it comes back to the fundamental question, what drives asset prices? And the way I think about that is it's monetary liquidity and return on invested capital. So let's put that in perspective for a second. When liquidity is rising, when the amount of money supply and capital in the world is rising, just think about it like inflation. If there's more money available for the same amount of goods, the price of those goods are going to go
So
up.
the price of those equities is going to go up because that's the goods.
Because that's the good, exactly. So when money supply is rising significantly, asset prices will go up. Now, here's the thing. The ratio of the price of asset prices to liquidity is not stable. And so sometimes it has a bigger impact and sometimes it has a lesser impact. So what is driving that? And that is your return on invested capital. So it makes sense that as your return on invested capital rises, you should have a higher ratio of the asset price to liquidity because for
Sure.
every dollar of liquidity is
You're
producing
earning
more
more.
profit.
Yeah.
Exactly. And so that's what you see historically. I actually model out return on economy-wide return on invested capital. And if you look at the S&P 500 relative to global liquidity, you see actually a pretty strong relationship and that ratio to the return on invested capital. So now it's essentially those two things that matter most. So now let's back it up. When you have geopolitical tensions in Russia, Ukraine, in the Middle East, wherever it may be, how does it impact liquidity and return on capital? That's the question you should be asking yourself. Okay, as opposed to how bad could this get? It's how is it going to impact liquidity and return on invested capital? So in this kind of multipolar, bipolar world, as kind of you're describing it. So the question would be, will there be less access to capital? Will capital from the East restrict the ability to go West and vice versa? And will that then in turn impact innovation and return on invested capital? The answer thus far has been no. There's been almost no restriction on capital. The US restricted Russia use of the dollar, and that may have long-term impacts because it disincentivizes people ultimately to be in dollars in the long term. But in the short term, it has had zero impact. And it's not like Russia is this great capital exporter, investing in great innovation. So it hasn't been much of an issue. So both the liquidity side and the return on capital side has been quite strong, which is why, despite a lot of concerns, these geopolitical tensions have not, in the slightest bit, impacted asset prices.
Haven't rattled markets one little bit.
Right. And so now the question is going forward, how will it? My very simple answer to that is I have no clue. Like,
Okay.
right? Like I'm not a future teller. I don't know. I have no edge on what's going to happen in geopolitical tensions. What I can tell you is whenever something pops up, that is the lens. That's the framework with which to put it through. Rather than worrying about the humanitarian crisis that happens in these conflicts is a real concern. But you don't want that concern to infiltrate how you think about markets because those could be two very different things. And so bringing it back to how will it impact liquidity and how will it impact return on invested capital, that's how to think about how it impacts markets.
Fantastic. Well, on that very interesting note, we will wrap it up. Daniel, thank you so much for being on the podcast. This has been a fascinating lens through which to look at the debt problem that we're all so aware of, but not quite sure how this all lends out. So thank you very much indeed. And for those of you who are interested in learning more about Daniel and his work, you should check out Blue Door Asset Management everywhere you get your information. Daniel Krausz, thank you very much. It's great.
Thanks for having me. Always a pleasure.
Thanks so much. Be well. Bye-bye. And thanks everybody for watching. More episodes coming your way soon.